It's 2 a.m., you can't sleep. You're scrolling through Twitter and everyone is making money. One guy turned $5,000 into $50,000. Another one bought crypto last week and is already up 200%. And you're just watching. So you open your brokerage app. Your hands are shaking a little. You tell yourself, this time I won't miss out. You buy the stock everyone's talking about. And for one brief moment, you feel like a genius. That feeling, that rush has a name. It's called FOMO, fear of missing out. And it is one of the most dangerous forces in investing. It has wiped out more portfolios than any market crash. And most people don't even realize it's happening to them. Today we're going deep into FOMO. Where it comes from, what it does to your brain, how it silently destroys your returns year after year, and most importantly, how to stop it. This is the video I wish someone had shown me years ago. To understand FOMO, we have to go back, way back. Thousands of years ago, humans survived in groups. If the tribe was running, you ran too. No questions asked. Missing out meant danger. Missing out could mean death. That instinct is still hardwired into your brain today. When you see others making money and you're not, your brain fires an alarm. It floods your body with cortisol, the stress hormone. It screams, do something, don't just sit there. This is not a personality flaw. This is biology. But in investing, acting on this alarm almost always hurts you. FOMO in investing usually looks like this. An asset starts rising fast, crypto, meme stocks, real estate, anything. You see the numbers. You see people bragging online, and suddenly your careful plan goes out the window. You chase the rocket right before it explodes. Here's the cruel irony of FOMO. By the time something is everywhere in the news, the run is usually over. The people who made money got in early, quietly, without the crowd. FOMO pulls you in at the worst possible moment at the top. And then the crash comes and you're holding the bag. This is called herd mentality, and it goes hand in hand with FOMO. When everyone around you is buying, your brain says it must be safe. Surely all these people can't be wrong, right? But markets don't reward the crowd. They punish it. The crowd almost always arrives late and leaves last. History is full of FOMO-driven disasters. In 1929, ordinary Americans borrowed money to buy stocks because everyone was getting rich. The market was going up every single day. People quit their jobs to trade full-time. Then October came, and it all collapsed in weeks. Then came the dot-com bubble of the late 1990s. Any company with a dot-com in its name was worth billions overnight. People poured their retirement savings into tech stocks they didn't understand. The Nasdaq rose over 400% in just 5 years. Then it crashed 78%, and millions lost everything. Then 2008. Real estate was the golden ticket. Everyone was buying houses, flipping properties, getting rich. Banks gave loans to people with no income, no job, no assets. Because missing out felt worse than taking the risk. Then the whole system collapsed, and the global economy went into freefall. And we all remember 2021, crypto FOMO hit like nothing before. Bitcoin went from $10,000 to $69,000. Dogecoin, a literal joke, became a multi-billion-dollar asset. People took out loans, sold cars, mortgaged homes to buy in. Then 2022 came and most of it lost. 70, 80, even 90%. So why does FOMO keep winning? Why do smart people fall for it over and over? Because the pain of missing out feels more real than the risk of losing. Psychologists call this loss aversion. Missing a gain hurts more than suffering an equal loss. So your brain will take a bad bet just to avoid the feeling of being left behind. It's not stupidity. It's just how humans are built. Studies in behavioral finance confirm this again and again. Losing $100 feels twice as painful as gaining. $100 feels good. This asymmetry drives irrational decisions in markets every single day. Investors sell winners too early and hold losers too long. They chase gains and run from temporary dips, both moves that destroy returns. Now here's the part nobody talks about enough. The antidote to FOMO is not willpower. It's not telling yourself to calm down. The antidote is having a plan so good that you don't need to react. When you know exactly what you own and why you own it, noise becomes irrelevant. The market can scream. You stay quiet. Your investment plan is your compass. It tells you what you buy, and when you don't. It removes emotion from the equation, at least partially. Without a plan, every hot tip and trending ticker becomes a temptation. With a plan, most of it is just noise. One of the best proven strategies against FOMO is dollar cost averaging. Instead of trying to time the market, you invest a fixed amount every single month. Market up, you buy fewer shares, but you benefit from the rise. Market down, you buy more shares at a discount. Over time, this beats almost every panic-driven strategy. Warren Buffett has said it clearly. The stock market is a device for transferring wealth from the impatient to the patient, not the smartest, not the fastest, the most patient. FOMO is the enemy of patience. Every time you chase, you're paying a tax on impatience. Let's talk about opportunity cost, a concept FOMO investors ignore completely. Every time you chase a hot trade, you pull money out of something solid. That solid investment keeps compounding quietly while you're busy chasing. Years later, the solid holding is up 300%. The hot trade is down 60%, and you chase the excitement. Compounding is the eighth wonder of the world. Einstein may have said that. But compounding only works if you leave your investments alone. Every time you pull out to chase something else, you reset the clock. You lose years of growth for a few weeks of excitement. FOMO is the fastest way to undo years of smart investing. Social media has made FOMO 100 times worse. Before the internet, you didn't know what your neighbor made on his stocks. Now you see everyone's wins in real time and none of their losses. People post gains. They hide losses. The highlight reel is not reality. You are comparing your full story to someone else's best chapter. And then there are the influencers, the pump accounts, the crypto gurus. They tell you this coin is going to 10x next month. They show you screenshots of massive gains. What they don't show you is that they bought in weeks earlier, and they're selling to you. While you think you're early, you're actually the exit. Here's a simple rule that could save your portfolio. Before buying anything, ask yourself 3 questions. 1. Did I plan to buy this, or am I reacting to hype? 2. Do I understand this investment well enough to explain it to someone else? 3. Would I still want to buy this if nobody was talking about it? If the answer to any of these is no, walk away. Another powerful tool is the investment journal. Write down every investment you make and why you made it. Write down what you were feeling at the time. Then 6 months later, go back and read it. You will be shocked how often emotion, not logic, drove your decisions. The boring path is almost always the right path in investing. Index funds, ETFs, consistent contributions, long-time horizons. It doesn't make for exciting content. Nobody goes viral for holding the S&P 500. But quietly, decade after decade, these boring strategies win. While the FOMO crowd cycles through losses, the boring investor just keeps compounding. Practically speaking, limit how often you check your portfolio. The more you look, the more you react. The more you react, the worse your returns. Studies show that investors who check their portfolios less often perform better. Turn off the notifications. Unfollow the hype accounts. Build a strategy and then let time do the heavy lifting. Think of wealth building like filling a jar 1 coin at a time. It's slow. It's boring. It doesn't feel like anything is happening. But one day you look up and the jar is overflowing. FOMO makes you throw the jar away and chase a bigger jar that doesn't exist. Patience, discipline, consistency. That's the formula. Let's zoom out 20 years. Investor A followed a boring plan. Index funds, monthly contributions, no chasing. Investor B chased every trend, rotated every 6 months, and always followed the crowd. After 20 years, Investor A has 3 to 4 times more money. The only difference was behavior, not intelligence, behavior. Here's the mindset shift that changes everything. Stop trying to win the moment. Start trying to win the decade. FOMO is about the next week, the next month, the next pump. Wealth is built in years and decades, not days. The investor who thinks long-term always beats the investor who thinks fast. So let's put it all together. FOMO is ancient. It's biology. It's not your fault that you feel it. But you can build systems that protect you from acting on it. A written plan, automatic contributions, limited news consumption, and a deep understanding of why you're investing in the first place. The market will always have the next big thing. There will always be a coin, a stock, a sector everyone is going crazy about. And there will always be a version of you that feels the pull. But now you know what that pull is. You know what it costs. Protect your portfolio. Protect your future. Don't let FOMO win.